Hi, I'm Michelle. Welcome back to Finally Revealed. In this video, I want to talk about the types of interest in financial situations and the difference in what type of interest you want when you are borrowing money versus what type of interest you want when you are trying to save money. The basic type, the most basic kind of interest is simple interest. And what that is a percentage of the total amount that's involved. Just, the amount of money that, for example, that you're borrowing plus interest. A simple interest is going to be the amount of money that you're borrowing, which is the principal, times a percentage of that amount of money. And the percentage is based on the interest rate, which is a percentage. And so that principal plus the interest, which is simple interest, the total amount is what you're going to pay. If you can borrow money based on simple interest, that's what you want to do because that is the cheapest way to do it. Compound interest is where you have interest on interest. Look at your credit card statement. There is a section on there. I don't remember what the heading is. It's somewhere near the top on the first page, and it says if you pay the minimum payment, this is how long it's going to take you to pay this off. And the reason is that while your credit card bill adds interest to the balance at a simple interest rate, if you don't pay all of the interest that is on that statement, probably plus a little more, then even though the minimum payment is less than the total amount of interest, you're going to be paying interest on interest. Because say, for example, you had a balance with $100 interest or finance charge, which is interest, added. But your minimum payment is only $86. Well, if you only pay $86, but $100 was added to interest, then there's $14 that's left over that's going to go on the next statement that's all interest, that's now going to have interest added to it. So that's how compound interest pops up in a lending situation, because a credit card is a loan. They're making a loan to you to buy whatever it is. And that's why they say don't use, some financial people or personal financial guru people will say don't use your credit card for food, for example, because if you go to Taco Bell and use your credit card and buy, I don't know, $20 worth of tacos, which seems like a lot, but then you bought other things also, and then you don't pay even just the interest on what that charge was, how much are those tacos going to cost you in 4 or 5 months? So you want simple interest when you are borrowing, and then you want to pay attention to make sure that that's all you're paying. Same thing for car loans and your home mortgage and things like that. You want to know what amount the interest is. Now on mortgages, your payment is going to be interest first before there's even principal. So that's pretty well taken care of. But on the others, if you're late, if you miss a payment, you're catapulting yourself into compound interest, and that's how your balance blows up, in addition to late fees, which now those have interest to them too, and it just snowballs in the wrong, not the Dave Ramsey snowball, but the bad snowball. Now over here on the investing side, and by investing I mean buying a mutual fund or buying stocks or a savings account, here there's also a simple interest factor where you have your savings account has an interest rate that applies, and you might get your statement every month and you've got $50 worth of interest. You got to have a big balance because interest rates are very low right now. But you look at that interest and you say, hey, I can take that money out and not touch my original savings amount, and here I've got income coming off. But you know what? If you leave that amount in the savings account, the next time interest is applied, that interest gets interest on top of it. That's your compound interest. Likewise, when you are in a mutual fund or a money market and there's a dividend or interest that goes into your account, if you set it up so that those dividends reinvest, meaning you have Apple stock and Apple pays a dividend, and you instruct that when there's a dividend paid on that stock, that they use it to buy more stock in that same company or mutual fund, that's how it grows exponentially. And because you get the original investment, and then in a stock situation, if the stock price goes up, you've made money. When the dividend comes in and that's applied to buy more stock and it goes up, you've made more money, plus the next time the dividend is paid, it's paid on the cumulative of what's in there from before. So when they say use your money to make money for you, that's what they mean. So I hope this was helpful to you. Simple interest when you owe money. Compound interest when you're saving or investing money. I hope this was helpful to you. I hope this helps you with your finances. If you have any questions or comments, feel free to leave them below. If this was helpful to you, give us a thumbs up and share it with someone who may benefit from it. Subscribe to see the next videos, and I'll see you next time.